Welcome back. You're still watching Business Morning on Channels Television, and today on the program, our conversation is centered around the 2014-2016 medium-term expenditure framework and fiscal strategy that was actually sent by the President to the National Assembly. It's supposed to guide how the National Assembly will deliberate on certain benchmark on certain projections, including oil prices and exchange rate, to finally bring out what the 2014 budget will likely look like. And I have here in the studio with me an economist, Gabriel Idahosa, and that's what we've been looking at for the last couple of minutes. Thank you so much, Gabriel, for sticking around.
Thank you.
Well, we know that debt servicing, the budget is proposed to increase to about 712 billion naira as against 592 billion naira in 2013. Is this something to worry about?
Not really. We've been able to manage our debt situation. That's one of the big things that the current administration, particularly the Minister of Finance, has done for the country. So our debt service levels by international standards are very, very low. And the structure of the debts we have now are mostly long-term, very long-term, 10, 15 years type of debts, unlike the 4 or 5 years type of debts we had, which accumulated and created.
Okay, so looking at the fact that it was actually increased by over almost by 200 billion naira, isn't this something to worry about? Because in light of what you've just said, if in terms of our debt, if it seems like it's dropping, then why do we need so much money to actually service whatever debts it is that we have?
Yes, that's because we have been borrowing.
Okay.
After we settled and we got waivers of all those really difficult debts of very short tenors, 5 year, 6 years, London Club, Paris Club type debts. Most of the debts we have now are multilateral, World Bank, the IFC for the private sector, and IMF, which are long term. And then the bilateral loans from the Chinese. Chinese give us loans for 15, 20 years, 5-year moratorium, and so on, and a little service fee. So these increases are in respect of those type of
what
problems.
about our domestic debts?
Domestic debts, of course, continue to rise because we've been borrowing and we are owing a lot of contractors. But the level for the size of the economy is not is not cause for concern. What will be for cause for concern is specific states. Some states are borrowing much more than they can service. So some states will have issues, especially the volume of domestic debts, if they don't watch it properly. But at the federal level, you have the Debt Management Office, which is a very professional office that manages national debts. And so, to a large extent, the federal domestic debts are pretty much managed to the point that you really do not have any serious concerns. And even that composition of that debt is being managed. The Debt Management Office is looking at foreign bonds. We are looking at the diaspora bonds that are going to be raised.
Yeah.
So it's managed in a way that it doesn't give much cause for concern.
Well, it's good that you mentioned the bonds. We know that about $500 million dollars worth of Eurobonds was raised a couple of years ago. We haven't really heard much about it. And then recently, the Minister of Finance actually did a roadshow with the senior officials from the budget office and the rest of it, and they were trying to raise $1 billion, which was oversubscribed. We had heavier investors from the US, and now in light of what we have in terms of servicing our budget, where do all of this monies, where do all of them come in?
They are embedded. Some of it has been spent. Some of them are embedded in certain projects. For example, you have the airports, renovations, and specific projects around the country, the Abuja mass transit. And
I remember
several.
that the minister said that the money actually, this Eurobond, the $1 million Eurobond was actually for power projects. So are we seeing much of that? In light of the fact that we are supposed to be unbundling the power holding company of Nigeria, and of course trying to settle arrears in terms of payment to the power holding staff and the rest of it.
Most of the government federal expenditure on power is going to go to the transmission now. Because the main transmission line grid around the country is still owned by the federal government and managed by the Canadian company Manitoba. So a lot of that now, because if you have so many private companies generating power, you need a national grid, a very robust national grid to carry that power around. to the various distribution companies around the country that are now privately run. That national grid is still owned by the federal government, and they still need to invest heavily in that. So some of that borrowing is going there. But what is important is that at the federal level, the Debt Management Office, the Federal Minister of Finance, are doing a pretty good job in managing our debt exposure. There isn't much concern as to the size or even the structure or composition of that. Where you have concerns are the fact that we need to work much faster to first generate foreign currency from outside oil. That's extremely important, because even though the interest rates are low, 1%, 2%, max 4, 5%, you need to continue to service them. So if in the long term, not in the short term, in the next 3 years, you probably are sure of $70 to $80 per barrel, probably. But in the long term, it's quite possible to see oil prices going even below the 70s and the 60s. So we need to very quickly address all the issues that can release our potential for non-oil foreign currency earning sectors of the economy. Whether it is solid minerals, whether it is tourism, whether it is Nollywood, whether it is agriculture, we need to work very, very quickly to release that potential so that we begin to see it. But in the short term, we don't really have any difficulties with the debt servicing.
So in all of this, how does it affect our external reserves?
Well, you know, it has been coming down steadily. From 50, we are at about 46, thereabouts. And the reason is clear. Your oil revenues are either flat or coming down. Some months they come down. Oil theft, lower prices means you don't produce enough and you don't sell at your old prices. So it's coming down, and that is the sign. That is the sign that our main source of foreign currency, oil, cannot help us in the long term. In the short term, it's doing it, and that's why particularly the legislative arm of government needs to work with the executive to understand that in the short term, you can still rely on oil. But in the long term, 4 years from now, it is absolutely certain that whether there is war in Middle East or not, the Chinese, the Indians are going to do everything to reduce their dependence on foreign oil. And prices of oil are going to go down. We need to know that 2 3 years ago when this was said, people said, oh, you are raising an alarm. Well, it's no more an alarm. US is now self-sufficient. Canada is a major exporter of oil. Brazil is self-sufficient in oil.
Austria, too, is also toward the line.
Austria is an exporter of gas massively. So it is no more speculation. It's not more some people who just want to raise any alarm. It's the facts of life that we are seeing. So we need to deal with that using what we have. We can export rice to the whole world. We have the capacity to do that. We can export cassava to the whole world. We can export palm oil to the whole world. We have the capacity to produce more palm oil than Indonesia or Malaysia if we want to do it. So these are the key things that should engage us, rather than price of oil is $100 tomorrow. Everybody is shaking and worrying about price of oil. It's going to go down. Okay.
Now, government, we know, has been particular about cutting the cost of governance, yet personnel cost is projected to increase from about 1.69 trillion naira to 1.72 trillion naira, as in this MTEF framework that the president actually sent to the National Assembly. What's your take on this?
Well, that's an area where there's a very huge gap between what they are saying and what they are doing. They keep saying they want to reduce the cost of government, but it's not possible in the short term. Do you reduce the salaries of the ASU lecturers? Do you reduce the pension obligations to the people that are leaving PHCN? Do you actually cut salaries of civil servants? Most of these things you cannot do. Recently, government said they can no longer execute the report of the Stephen Orosai panel, which had suggested the merger of various federal agencies. At that time, they counted about 400 parastatals. Federal government, one government had 400 parastatals, and they felt you needed to merge a lot of them to reduce the cost. But 2 weeks or last week, government says no, they cannot implement that policy anymore because they have found that they won't save much money by measuring those parastatals. So it just shows the lack of political will to do what you got to do. And of course, it's obvious that the government is looking at the social cost of doing it, the upheavals, the strikes, the commotion that comes from all of that.
Yes, and because we have to remember that, you know, the cost of living in Nigeria is actually still high. So even if you want to reduce the cost of governance, or if it's been increased, so to speak, and you're trying to reduce it, you have to, what the government should be doing, I'm guessing, is that they have to make things right. Right now, the average Nigerian has to spend so and so amount of money to get from point A to point B. When you go to the markets, the food prices is also on a high. Now, if all of these factors we have on ground, and then we have the government saying that reduction in the cost of governance is next to impossible, how do we tie it?
Well, that's the catch-22. You can't reduce the cost of government. Therefore, you have less money in the budget for capital expenditure. Because you don't have capital expenditure, you can't build the roads. Government says they cannot build the roads, they cannot build the rail lines that will reduce the cost of transportation and make the cost of living easier. They cannot develop sites where you and I can get a mortgage and build a home and pay over 30 years. Because government says they don't have the funds to do that. So cost of living is high. Because cost of living is high, you cannot reduce the cost of government. So you are tied in all that. How do you get out of it? Various solutions have been tried and very well succeeded in various countries. First of all, you don't have to build rail lines by yourself. As we have seen with the telecom, there are investors all over the world who have operated private rail lines for years, for 100 years, 50 years. And they are quite happy to come and build private rail lines in Nigeria if you just provide the right regulatory and operating environment, just like you've done in telecom, just like you are trying to do in power. So that is the thing that government should begin to look at.
I guess it's a gradual thing. But then we're also supposed to see an increase in the budget deficit. For 2013, it was actually 887 billion naira. Now it's been increased to 911 billion naira for 2014. Are you worried about this, or should we be worried about this?
Yeah, of course you have to be worried, because, of course, the numbers are obvious. If your oil revenue is coming down and your cost of running government is going up, of course, the numbers will just show the deficit. Plus the fact that certain sectors of the government are not willing to reduce. Even if the executive is willing to reduce, the legislators are not ready to reduce. So you are going to have to deal with that deficit. And what the Ministry of Finance and the Economic Management team is always struggling with is looking for where you can reduce with minimal social cost. Areas you can reduce without people going on strike, without a whole set of people going up in arms to say you are denying them of one privilege or facility or the other. So it's always a big struggle to find where to reduce in the budget without a high social cost. So you are going to have these deficits in the budget until you find this. Of course, taxation has to improve significantly. There is improvement, but there's still a huge room for the efficiency in tax in our tax systems. You've got to deal with that significantly. And then you've got to really continue to address the question of how do you convert our potentials in all these other sectors we've talked about into reality, that we now begin to export rice to all our neighbors.
I was just going to ask that. So what can we do to have a win-win situation? We have a projection for the 2014. We already know what 2014 is going to look like. That's the budget, that is. But what can be done for everybody to have a win-win situation? Because most of what has been highlighted here, we've seen a steady increase in most of the key projections, and it's actually a little worrisome. So what can be done, or what should be done, to ensure that every party concerned wins at the end of the day?
Well, short term, you cannot change. Most of the things are big structural policy issues you cannot do in 1 year. But 2 years, for example, there's the hope that by December 2014 or December 2015, we will achieve self-sufficiency in rice.
Okay.
So those are the kind of things you can do. You can say, rice, let's deal with it and really work on it. The way we worked on cement with the private sector, the way we work on telecom, we can take a few items and say these items, we palm oil, 3 years, we want to be self-sufficient. That program will create jobs. It will reduce our foreign exchange leakages. It will improve our exchange rate. It will transform the growth to the development we are always talking about. So those things can happen, but not in a 12-month budget. It will take a longer period.
Okay. Now, just before I let you go, Gabriel, let's analyze some of the risk highlighted in the fiscal strategy paper. Well, they talked about the possible effect that the global economic downturn would have on Nigeria's economy. Could you just highlight some of those things we should be looking out for?
Well, the effects are here already, and they will continue to be there. Because of the recession in Europe, they don't buy as much oil from us as they would have bought if the economy was growing very fast. So the impact is already there. So it's not going to grow, it's just going to remain where it is. America is now growing at 2%, 2.5%, but we will not get much from that because they are no longer buying our oil. So the impact will be really flat. The Chinese, the Indians, because they are still growing pretty fast, between 5 to 7% between India and China, yes, we will have sustained demand for our oil in the short term. So on the balance, the effect on our economy will be about what it is now.
Okay, what about the risk of capital flow reserve reversals?
Capital flows belong to the owners. If I bring money to buy shares in the Nigerian Stock Exchange from America and the stock exchange is doing well, I leave it here. Or if I see any sign that there's a problem, I just sell my shares and move on. So it's up to you to maintain stable, investor-friendly policies. They must be stable and they must be investor-friendly. And that's what we are seeing. The new management at the stock exchange has done a great job. They are now they are now generally regarded by the investment world locally and abroad as very investor-friendly. A lot has been done in that area. SEC is also doing that. The federal government, of course, we saw it yesterday. The whole world is now saying, Nigeria, you are getting it right. We are supporting you. To keep on doing the right thing. Because,
in fact, my head was swelling with pride. I was so
because
proud of
it
myself.
just doesn't happen that the president of a country is asked to come and do that. So the whole world is acknowledging the right things we are doing. In the Minister of Finance, the Minister of Agriculture, the Minister of Trade and Investment, they are saying you are doing the right things, we support you, but you still have a long way to go. So we should just keep doing the right things and doing them faster and on a larger scale, particularly now that power is out of the way. Exactly what we did in power and telecom, we must do in railways. We must get investors moving very quickly in large billions of naira of foreign money to come into our railways. And instead of a 25-year master plan for a railway, you can get investors come from abroad. And in 5 years, you can build all the rail lines that you need.
Well, thank you so much for sharing your thoughts with us on the program today. It was quite an interesting discussion. To have a good day, sir.
Thank you.
Well, that's the program for today. Thank you so much for being a part of it. I'm Harriet Agbin.